Hello everyone and welcome to the revision video for CA Inter Paper 5 Amalgamation of Companies. Now this is a very important topic and I hope you have done this at length. This is a video which will help you in a quick revision and refreshing of the concepts. We are not going to do any sums over here. We're just going to quickly run through the concepts and this will help you at the time of your revision or the day before your exam. So we'll get started with the basic theory, the basic meaning of these terms. So there are three concepts which are getting covered over here. First is amalgamation. Amalgamation means that there are two companies, let us say A and B, and they will close and a new company AB will form. So that is an amalgamation case. In which case, when we are doing the accounting, we have to remember that there will be two separate PCs, purchase considerations, for company A that is closing as well as company B, two separate net assets taken over, and a single balance sheet for the new company AB. There will be two liquidations, two closing of accounts. No reserves will be taken over, as you will study earlier, either for A or for B. When you look at absorption, on the other hand, absorption refers to the scenario where one company acquires another company. So there will be one liquidation in such question, the company that is closing, and the reserves of the existing company, the assets and liabilities of the existing company will continue as it is. So that is the absorption. Most of the questions have come pertaining to absorption, absorption being the most important, followed by amalgamation, and rarely have been there questions regarding external reconstruction. External reconstruction refers to a scenario where there is one existing company, it kind of closes and there is a new company that is formed to take over the business of that company. So it's like kind of rebranding or restructuring and forming a new company. So there is a company A which closes, so there is one liquidation and there is a new A. So it's a rebranded company which takes over this. So this is just a theory based discussion. Having said that, from an exam standpoint, we just need to identify whether it's an amalgamation, absorption, etc. for understanding whether the existing assets and liabilities and reserves will appear or not. Other than that, these terms in practice can be used interchangeably. Okay. Now, while calculating or while solving a typical question of amalgamation, which comes for anywhere between 15 to 20 marks, usually in your exam, there have to be 4 steps or 5 steps at least that you have to be mindful of. The first step involves the calculation of PC, purchase consideration. This is probably the most important step, and there have been instances where institute has asked you independent 5-mark questions which are pertaining just to the calculation of PC. So this is definitely something which is important. Purchase consideration. I'll just run you through the steps first and then we can go into detail for each of them. First step is calculation of purchase consideration. That is a payment that you need to make to the owners of the selling company. Second step is calculation of net assets taken over. That is the assets and liabilities of the selling company which are taken over. Third step will help you calculate the goodwill. You will compare the purchase consideration in step 1 with the net assets in step 2 in order to calculate the goodwill or the capital reserve as the case may be. In the fourth step, if journal entries are asked, you will pass the acquisition entries. That is the entry for business purchase, paying off the liquidator of the selling company and taking over assets and liabilities. We'll discuss that. And also certain adjusting entries. There may be certain adjustments like intercompany receivables, payables, unrealized profit in stock, statutory reserve, etc. for which you might need to pass entries. And in the last step, you might need to prepare a full-fledged balance sheet of the new company after absorption or after amalgamation as the case may be. Achha, so these are the 5 steps. We'll go into the detailing for each of them. First step is the calculation of PC, that is purchase consideration. PC refers to the payment which is made to the owners of the selling company, and who all are owners? Well, owners are shareholders, and shareholders can be equity shareholders as well as preference shareholders. Are debenture holders owners? No. Are loan lenders owners? No. Are trade payables owners? No. So the payment that you are making or you are agreeing to make to the owners of the selling company, that is equity and preference shareholders, is considered to be a part of PC. Payment that is made for other liability items will not be a part of PC. Acha, the equity shareholders and preference shareholders can be paid in any mode. They can be paid in cash, they can be paid in shares, they can be paid by debentures, they can be paid in any mode. The mode in which the payment is made does not determine whether they are a part of PC or not. To whom that payment is made determines that it is a part of PC. If the payment is made in equity shares but to debenture holders, it is not a part of PC. However, if the payment is made in the form of debentures to the equity shareholders of the selling company, it is a part of PC. So we have to see to whom the payment is going rather than in which form the payment is going to determine whether it is a part of PC or not. So over here, PC refers to the payments to the shareholders that can be equity as well as preference both of the selling company. PC can be made in any mode. It does not really matter in which mode it is paid. The payment to the debenture holders, creditors of the selling company will not form a part of PC. While determining the PC, the mode of payment is irrelevant. The parties to whom the payment is made is relevant. And then comes the important step. How do you calculate the PC? Well, there are two methods which are possible. First, there is what you call as a net payments method. That is the amount that you have agreed to pay to the owners of the selling company, which is a more popular method. And second is, in a theoretical, in an exam related scenario, what if we have not been given how much is the amount to be paid? We have just been told that the owners of the selling company have been agreed to be paid shares of the purchasing company. We have not been given the exchange ratio. We have not been given the number of shares. We have just been told shares have to be issued or the necessary shares have been issued. Array, necessary means what? How many shares are going to be issued? Well, in such scenarios, you will try to make an assumption. One can assume that if nothing is given, PC is 0. You don't pay anything to the owners of the selling company, which is an unreasonable assumption. If someone is transferring a business to you, they would expect some consideration, but the problem is, as a student, the consideration is not given in the question. So rather than assuming the consideration to be 0, a much more reasonable assumption that can be made in such a circumstance is that the consideration will be the same as the net assets of the selling company. जितने assets and liabilities है, minimum उतना तो हम expect करेंगे. So when will you calculate the PC using net assets method? Well, if the details about net payments are not available, that is when you will look at the net assets. Sir, why? Because net payments is more superior. It may be possible that I have net assets worth of only 100. However, the purchasing company is ready to pay 150 for me. So my PC is 150. However, if nothing is given about the amount of PC, then we can reasonably assume that, well, we don't know how much is the PC, in which case we will assume that our assets and liabilities are net worth 100. So the purchasing company should at least pay us 100. So the first preference will be using the net payments method, and if that is not possible, then we can use the net assets method. Okay, when we look at the net payments method, what will we take? Well, we will take, for example, shares of the selling company. There can be various ways in which you can find the net payments. There is a typical scenario where, for example, if there is a selling company and you have been given that selling company has equity share capital of let's say 1000, that is made up of 100 shares of rupees 10 each, one can say that, okay, against 100 shares of the selling company, what is issued? Sometimes directly cash is paid. So 15 rupees is paid for each share of the selling company. 100 into 15, 1500 will be PC. Or we might have agreed to issue shares of the purchasing company, where you might be told that for one share of the selling company, 1.5 shares of the purchasing company will be issued. Or against 2 shares of the selling company, 3 shares of the purchasing company will be issued, which means we would say that, okay, 100 into 1.5 upon 1, so that is basically 150 shares of the purchasing company P that will be issued. Achha, each share of the purchasing company is worth how much? Well, if nothing is given, we'll assume the face value. If a specific issue price or intrinsic value is given, we can take that. So this will come to, let us say, 1500. This is one of the methods to calculate PC. You have to look at the data points, the facts of the question to determine how PC is to be calculated. For example, the question might tell you that the PC is to be paid in cash, in which case there is no exchange ratio. Or the question might tell you that it is agreed that for each share of the selling company, we have agreed to pay, let us say, 15 rupees, in which case the PC would be 100 into rupees 15. So it should be 1500. However, this is agreed to be discharged by issuing shares of the purchasing company, and each share of the purchasing company, let us say, is worth rupees 10. Then 1500 will be discharged by issuing 1500 divided by 10, that is 150 shares. Sir, is it necessary that the issue price always has to be the face value? No. It is possible that the shares that P is issuing is actually worth more. For example, Hero Honda as a company or Hero Motocorp as a company has a share which has a face value of only 2 rupees. However, the market price is around 3000 rupees. So when Hero Motocorp gives 1 share, either on account of an acquisition or for any other reason, what it is giving is something worth 3,000. It is not giving something worth just 2 rupees. It is giving an instrument which can be sold in the market for 3,000 rupees. And as a result, what you will take over here is the issue price of P, which is the market value, intrinsic value, or the agreed value, which is agreed for P. Sir, why are we taking for P? Because 150 in this formula is the shares of P that you are issuing, and each share of P is, for example, worth 10 rupees. So this is how you calculate the amount of payments. Now, there is a huge variety of questions and we are just doing an overview over here. So I would strongly recommend that you do practice PC. One of the adjustments that the institute uses is, it tells you that it does not tell you this exchange ratio of 1.5:1 or 3:2. 3:2 means for every 2 shares of the selling company, 3 shares of the purchasing company. It says that the intrinsic value is the real value of the shares. The intrinsic value of the purchasing company and of the selling company is given to you. Selling company, intrinsic value is given as, for example, 45. Purchasing company, the intrinsic value is given, for example, as 30. In which case, fair enough, the question tells you that we are doing a barter. What the shareholders of the selling company says, we are giving you shares of our company which is worth 45. You are giving me shares of your company which are worth 30. So how many shares should you give? In order to ensure parity, it is like saying, loosely speaking, I have 450 grams worth of gold. So there is one biscuit, gold ka biscuit bolte hain, which is worth 450 grams. You have one biscuit which is worth 300 grams. We want to exchange in a fair way. Is it fine if I give you my one biscuit and you give your 300 gram biscuit? We will say, no, this is cheating. Ideally, I've given you 450 grams of gold. You should also be giving me an equivalent amount, and hence we would say, okay, एक biscuit से काम नहीं चलेगा. You will have to give probably 1.5 biscuit if that is possible. 1.5 biscuit of gold, 1.5. So 300 plus 150, half biscuit. So that will be 450 grams. So in a similar way, we are saying that, well, we are exchanging shares. We are acquiring as a purchasing company the shares of the selling company, and we are issuing our shares. The question tells you that the exchange ratio will be based on the intrinsic value. Abhi intrinsic value is given to you. Now, how do you find the exchange ratio? Well, exchange ratio is always calculated as the intrinsic value per share of the selling company in the numerator divided by the intrinsic value per share of the purchasing company. So, for example, 45 upon 30, which is 1.5:1, which logically makes sense. It means that for one share of the selling company, 1.5 shares of the purchasing company. Sir, why? Well, because selling company share is more valuable. It is worth 45. Purchasing company share is worth only 30 rupees, which means I'll have to give 1.5 share of the purchasing company to each shareholder of the selling company. I hope that's clear. Okay, so this is the first part. This is regarding the exchange ratio. If the question tells you it is in the ratio of intrinsic value, you'll have to take the intrinsic value of the selling company in the numerator, purchasing company in the denominator. Acha, what about the issue price of these shares? We decide ultimately that 150 shares of the purchasing company are to be issued, but each share of the purchasing company is worth how much? Well, if a particular value, agreed value, intrinsic value, market price is given, you will take that. 12 rupees, so 12 rupees, 15 rupees, so 15 rupees. However, if no value is given, then you will assume that the face value is the intrinsic value. So the issue price of P, if a specific issue price is given, we will take that in the working. However, if no such issue price is given, then we can take the face value for the purpose of calculation of PC. Next does not come as much as often, but sometimes what happens is on applying exchange ratio, the number of shares comes in decimals. For example, selling company, for example, had 95 shares and the exchange ratio which is agreed is 1.5/1, which means 95 into 1.5 will be 142.5 shares to be issued. Abhi 142 shares to issue ho sakte, but what about the 0.5? Can you issue 0.5 share? No. And as a result, against the 0.5 shares, you will pay cash. These are called as fractional shares. So, well, for half a share, well, each share is worth 10 rupees, half a share will be worth 5 rupees. So, I will issue 142 shares, and for the half a share, I will pay cash. This is called as a fractional adjustment. So, this is fractional shares, that is 0.5 shares into issue price, for example, 10. Aja. And in the last case, in certain questions, exchange ratio is not given. However, the agreed value to be paid per share of S is given. For example, we discussed 15 rupees over here, 100 into 15, in which case the purchase consideration can be calculated as a number of shares into the agreed price. Okay, so this takes care of the PC using the net payments method. Net assets method, as we have discussed, is the inferior method. It is to be used as a proxy. If you do not know how much payment is made, then we can assume that the amount of payment made must be equal to the net assets. So in case details of net payments are not given, it is reasonable to assume that P will have to pay an amount equal to at least the net assets of S. If this is not given, then the net assets of S that will have to be paid. Now the question is, these net assets of S will be based on the book values or based on the fair values? Well, logically it has to be based on the fair value. Think of it this way. You are, let us say, staying in a flat which was purchased by your parents, for example, 30 years back, when the price of the flat was barely 1 lakh. Now the price of the flat is, let us say, 3 crores. If someone comes to buy your flat, will you give the flat only for 1 lakh? No. Sir, but books mein 1 lakh hi dikh raha hai. It does not really matter. The fair value of the flat is 3 crores and hence you will give the flat for 3 crores. This time around, along with the flat, you are giving the entire business. One of the assets of the business is the flat. So if I have to charge the PC, then for each and every asset I will expect to receive the fair value. And as a result, the net assets that will be taken over, as well as the net assets that you use for the purpose of the PC, purchase consideration calculation, will be based on the fair value of the net assets and not based on the book value of the net assets. So these will be taken over at fair values. You can refer the theory later. Acha. Now there are two types. Now when we look at net assets, you will take over all net assets. There may be certain questions where you might be given a mechanism to calculate goodwill, like you must have even studied in your partnership. You must be given a mechanism to find super profits and super profits into the number of years purchased. Data might be given, and based on that you can calculate goodwill, and that goodwill may be used if data is given. Or there may be certain unrecorded assets or certain unrecorded liabilities which were not recorded by the selling company in its books because it thought that payment will not have to be made. However, on acquisition, like an ongoing lawsuit, the requirement is कि भैया अगर आपको acquisition karna, you will have to settle the lawsuit. Now you will have to make that payment. This is now a real liability, and as a result, if the question tells you that there are certain unrecorded assets and liabilities, they will also have to be considered while calculating the net assets. You can show these unrecorded assets as either other current assets if they are assets, or other current liabilities if they are liabilities, if nothing is given. Achha. So this is PC. Second step is net assets taken over. If PC itself is calculated using the net assets method, then we will have the second step done in front of us. Now, we will first finish these steps and then probably go to the methods. If you kind of skip this page, the third page for the time being, and you directly go to the accounting for amalgamation or absorption using what you call as a purchase method. This is a standard method. If nothing is given in the question, you will do the amalgamation or absorption using the purchase method if no separate data is given. The first step involves calculation of PC, which is first preference using the net payments method. If that is not available, using the net assets method. You will have to show a separate working in almost every question to find the PC. There are dedicated stepwise markings allotted to that. Second step is calculation of the net assets taken over. These are assets and liabilities taken over at fair values. If there are any unrecorded assets or liabilities which also have been agreed to be taken over, wo bhi aayega. If there is goodwill calculated in a specific way, that will also come over here. So these are at fair values, and if fair values are not available, then you can take the book values. Achha. Now let us say the net assets taken over come to 1000, whereas the purchase consideration is 1200. So you are agreeing to pay 1200 for something which is worth 1000. Why are you agreeing to pay 200 more? See, what you are acquiring is actually a business, and business does have goodwill, it does have reputation, and probably this 200 extra you are paying for goodwill. So in the third step, you compare the PC, which is 1200, with the net assets, which is, let us say, 1000, and hence there is a difference. This difference of 200, if positive, will be taken to goodwill. However, in rare circumstances, it is possible that the difference comes to be negative. For example, we are paying 800 for something which is actually worth 1000, which means we are paying 200 less, and hence it's a gain. Now, goodwill is an asset. You can't show a negative goodwill. Then what is this 200 negative according to you? Well, this negative 200 is nothing but what you call as a gain on purchase. Now, gain is usually recognized on sale. We do not typically recognize a gain on purchase. However, here, because you are paying actually 800 and you are taking over assets worth 1000, there is going to be a gap of 200 which has to be recorded somewhere. Now, this is an unusual item. This is a rare item, and hence we do not take it to the profit and loss account. This does not arise in the day-to-day course of your operations, and hence it is taken into a separate account called as the capital reserve. Sir, why capital reserve? Why not general reserve or profit and loss? Because we don't want it to affect the distributable profit. Because this is the profit on purchase of a business. Typically, you recognize gain or losses only on the sale of a business. This is one of the only places in your entire syllabus where you recognize a profit on purchase. And since it is such a special item, you recognize it as a capital reserve. Okay. So this is your step 3. Now you go to step 4. In step number 4, you will take over assets and take over liabilities. So what do? You can pass 1, 2 or 3 entries. There have been different solutions given in the study material, RTPs and suggested answers. Sometimes they use 2 entries, sometimes they use 3 entries, sometimes only 1 entry. What we will do is the longest. अपन बोलते भाई अपन सबसे safe रहेगा. Let us pass 3 entries. You can use direct entries as well, but this is the safest approach. So acquisition entries. What is the first thing you do? Let us assume the PC is 1200. Purchase consideration is 1200. In which case, we will pass the entry that for the business we need to pay 1200. But to whom do we need to pay 1200? Well, to the liquidator of the selling company. So the journal entry that will pass is the business purchase account debit to liquidator of selling company. So this is the first entry, business purchase account debit to liquidator of the selling company. This entry will be at the PC, for example, 1200. After this, what we will do is we will pay off the liquidator. And that is when he will give us the business. So we will pay off the liquidator. So second entry is the liquidator account debit 1200. Acha, this is paid in what form? Well, it may be paid in the form of shares, it may be paid in the form of cash, it may be paid in the form of debentures, it can be paid in the form of preference shares, there may be premium, whatever it is. So for example, this is discharged by issuing 100 shares at the rate ₹12, 2 रुपए का premium है. Then this will be equity share capital 100 into 10, which is the face value, let's say 1000, and these shares are issued at a 2 rupees premium. So as a part of securities premium, for example, 200 will go. Let us assume there is no preference shares, there is no payment. Now the liquidator account, which is a temporary account, is closed. However, the business purchase account is still open. Now, what does the business represent? The business represents individual assets and liabilities of the selling company, and as a result, in lieu of the business, we will take over the individual assets. Assets account debit, this may be land, building, inventory, trade receivables, everything. Sundry liabilities, to debentures, trade payables, loans, whatever, at the agreed values. So you will take over all assets, all liabilities. For example, the assets over here are 1300. The liabilities over here, for example, are 300. Acha. To business purchase, the temporary account that we had created now closes because we have actually taken over the assets and liabilities. To business purchase 1200, and hence there is a balancing figure that you go to see. The balancing figure over here is on the debit side, which will be goodwill. If the balancing figure comes on the credit side, it will be capital reserve. So these are the 3 standard entries that we pass. We also call them as acquisition entries. This will be passed in the books of the purchasing company, and you will pass this only if it is specifically asked in the question, not otherwise. AS 14, accounting over here is governed by Accounting Standard 14. AS 14 deals with the accounting for assets and liabilities in the books of the purchasing company, and this is the treatment that you have to give. Acha. Now, after the acquisition, there may be certain adjustments that you may have to do. For example, in the books of the purchasing company, selling company prior to the acquisition was appearing as a debtor. Purchasing company had to recover 100 rupees. In the books of the selling company, the purchasing company was appearing as a creditor. We had to pay 100 rupees. Now we have taken over all assets, all liabilities of the selling company. Selling company closes, and hence as a part of these assets and liabilities, I have also taken over the payable, by the way, to my own self. And on the assets, I have a receivable, by the way, from my own self. And as a result, it is an intercompany adjustment. Mutual indebtedness, and hence we'll have to eliminate it. So if it is a creditor and a debtor, the entry will be trade payables account debit to trade receivables, eliminated. Bills payable, bills receivable, the entry will be bills payable account debit to bills receivable. Loans given, loans taken, the entry will be loans taken account debit to loans given, and as such you will eliminate it. Okay, this same applies for bills receivable, bills payable as well. It's a very easy adjustment. Another interesting adjustment that can come is if there's an unrealized profit in stock. So for example, purchasing company had a stock which had a cost price of 100. It sold this at 120 and hence it kind of recognized a profit of 20. Now this sale was made to a separate company which existed called as S, which kind of purchased these goods at a cost price of 120. Acha. Now what happens is P manages to take over S, and if P manages to take over S, among other things, it will also take over the stock of this company. And hence what will happen is, in the books of P, what will happen is a stock which it had sold to S will appear in its books as 120. Now as per AS2, stock has to appear at cost, and at the same time, the cost of this stock to P really is 100. Yes, it sold it to S, but now S got acquired, and hence there is some unrealized profit in this stock which is worth 20, which needs to be removed. Why does it need to be removed? Well, it needs to be removed because of the acquisition. Had there been no acquisition, there was no error done by P, the profit should have been recorded and was recorded. However, because of the acquisition, this 20 of profit is now something which ideally will not be recorded, but you can't reverse the profit already recorded. So what does the institute tell you to do? Institute says that, well, inventory आपको cost पे लेके आना, you'll have to credit the inventory. But double entry system, if you credit the inventory, something has to be debited. Sir, will you debit the profit and loss account? The standard says no. This is also a special adjustment happening on account of a special scenario, and hence whatever is a gain or loss that happens as a part of this special arrangement is to be recognized in the goodwill or capital reserve. For example, we have recognized a goodwill of 200 or we have recognized a capital reserve of 200. So we are boasting to the world कि देखो हमने business खरीदा सस्ते में if there was a capital reserve worth 200. However, because of that business acquisition, yes, you have earned a profit on purchase of 200, but the 20 of profit that you have already recorded on sale of stock is kind of redundant, and as a result we will say that okay, let us debit it to the capital reserve account debit to inventory, and hence your net profit on purchase will be 200 minus 20, that is 180. Or if you have overpaid for the purchase, we would say that okay, we have paid 200 more as compared to the assets. In reality, you have not paid 200 more, you have paid 220 more as compared to the assets. The 20 additional increases the cost and hence the goodwill. So over here, if there's any unrealized profit in stock, you will first take over the inventory at full value, in our example at 120, and then for the unrealized profit for the inventory which is unsold. Now it is not necessary that the entire 120 is unsold. It is possible that out of this 50% of the inventory is sold to an outsider, and as a result there is only 60 which remains unsold. Now the profit which is unrealized, the total profit was 20, but 20 was on the entire stock. Now 50% of the stock is sold, 50% is unsold, and hence the unrealized profit is 20 into 50%, that is only 10 rupees. The entry has to be passed only for the unrealized profit in the unsold stock. So unrealized profit in stock would be eliminated through either goodwill or capital reserve. This is because the profit needs to be reversed due to the amalgamation. The birthplace of this is the amalgamation. Amalgamation ना होता तो profit भी reverse नहीं करना पड़ता. And hence the unrealized profit would be adjusted against the goodwill or the capital reserve only, and hence the entry will be goodwill account debit to inventory. If there are certain liquidation expenses or realization expenses which are paid by the purchasing company on behalf of the selling company, this is an expense also that you are paying. This is also an expense that you are paying because of the acquisition, and hence this will also either increase the goodwill or reduce your profits on purchase, and hence the entry will be goodwill / capital reserve account debit to bank if there are any liquidation expenses over here. Now there is a new adjustment that will come which is on statutory reserves. Remember, in a regular acquisition, you take over assets and liabilities. Assets are transferable. You can transfer land, building, machinery. Liabilities are also transferable. However, reserves are something which cannot be transferred. You really cannot transfer your reserves. अपने को मन हुआ अपन लैंड किसी को बेच दिया, possible. Can you transfer your P&L to someone? Can you transfer your capital reserve to someone? No, these are not transferable items in the first place. And as a result, as per AS 14, and rightly so, if there is a regular amalgamation or acquisition or absorption which is in the nature of purchase, you do not take over the reserves of the selling company. Yes, you take over the assets. Yes, you take over the liabilities, but you do not take over the reserves. However, it might sometimes happen that there is a statutory reserve that has to be maintained for a specified number of years. May be required based on income tax laws, based on some export commitments or some regulatory requirement. Now, the selling company had to maintain a particular reserve. For example, export profit reserve for a period of 5 years. 2 years have passed and now the selling company closes. However, as per legal stipulation, it has to be maintained for a period of 5 years. The purchasing company has taken over the business of the selling company, and hence the law requires that that export profit reserve should now be maintained in the books of the purchasing company for the remaining 3 years. The challenge is you cannot take over the asset, you cannot take over the reserves of the selling company. Then how will you maintain it? Well, in order to maintain the law is supreme. In order to kind of comply with the law, you will have to create a statutory reserve. Okay, reserve as a credit balance, you will have to credit it. But there is double entry system of accounting. So if you credit the reserve, something has to be debited. Sir, debit kisko karenge? Well, a temporary account called as amalgamation adjustment account will be opened, or an amalgamation adjustment reserve will be opened. So your entry will be, let us say 100 is the export profit reserve. Amalgamation adjustment reserve account debit 100 to export profit reserve 100. This reserve will appear in the books of the purchasing company and it will continue to appear for a period of 3 years. After 3 years is over, this reserve is not needed. The amalgamation adjustment reserve is also not needed, and hence you will reverse the entry. You will pass the entry export profit reserve account debit 100 to amalgamation adjustment reserve 100. This is after 3 years. Okay, so a statutory reserve is a reserve which is required as per statute or as per law, in which case you will have to create a special account called as amalgamation adjustment reserve account. Where will the amalgamation adjustment reserve appear? In the Schedule 3 balance sheet, it will appear along with the reserves and surplus only. Sir, but it has a debit balance. Yes, sometimes even profit and loss can have a debit balance, in which case you show it as a negative number. So in a similar way, over here you will show it as a negative number, like a statutory reserve of 100, P&L let us say of 20, general reserve of 30, let us assume is there, less 100. This is how it will appear in your Schedule 3 balance sheet. And lastly, you have a scenario where debentures can be taken over. Debentures, remember, are not a part of PC. Preference shares and equity shares are a part of PC. But if debentures are taken over of the selling company, these debentures will be on the letterhead of the selling company. Now the selling company closes and there is a purchasing company, so you will have to issue new debentures on your letterhead, and hence you will credit the new debentures and debit the old debentures. There are a few interesting adjustments over here where sometimes these debentures may be issued at a premium, at a discount, so you have to be looking at the language carefully and deciding whether the debentures are at a premium or a discount. So it may be given that the existing debentures are taken over at a premium of 10%. and new debentures are issued. So we'll say, okay, the existing debentures are 100 plus a premium of 10%, that is 110, and hence new debentures worth 110 will have to be issued. If nothing is going, you'll assume that the new debentures are issued at par. Okay, so these are the standard adjustments. Having said that, there can be other adjustments as well, like a fresh issue of shares, etc., that can come. However, this is what you typically need to be on the lookout for. Okay. Now, typically, most of the questions ask you to prepare the opening balance sheet. Now, opening balance sheet will be made for the new company, let us say X Limited, into bracket after absorption. Balance sheet as on so and so date. You will prepare the entire Schedule 3 format for the relevant line items. You will write down the notes for items which have more contents, like share capital, for example. While you write down the note for share capital, you have to remember that you also mention the disclosure that of the above, X number of shares are issued for a consideration other than cash. Be careful about that because the shares that you are issuing in absorption is typically for a consideration other than cash. Second, you will have to write a note for reserves and surplus. In case of a reserves and surplus, there are 4 specific things which I want you to be careful in each and every question. First, check if it is absorption or amalgamation. If it is absorption, the existing company's reserves will continue to appear. New companies' reserves are not taken over, but existing companies' reserves will be there. In case of amalgamation, there are no existing reserves because a new company is formed. Second, you have to check if there is any capital reserve in step number 3 of the working. If there's a capital reserve, it will also come over here. Point 3, you will have to see if the securities which are issued as a part of PC are at a premium or not. If they are at a premium, either equity shares, preference shares, or whatever securities are at a premium, then securities premium will also be coming over here. And point number 4, if there is any statutory reserve / amalgamation adjustment reserve, you will have to also incorporate that in the workings here. So these are the 4 things that you have to be careful in the reserves note. For other assets, other liabilities, you can prepare it in a manner that you feel comfortable. Having said that, the general thumb rule is if there is more than one item, then you should prepare a note. Like you have in tangible PP, you have land, building, machinery, prepare a note. But if there is just a single item, like there's just debentures, you can just write down long-term borrowings into bracket debentures. You prepare the note, that is best. But typically in the exam, if you don't have time, if there's a single item, you can also write that into the brackets. That will work. Okay. Now, before we proceed to the books of the selling company, which is closing the business, we want to now go back to the 3rd page, which we had left. Amalgamation can be of 2 types. The accounting for amalgamation can be of 2 types. All that we have studied is for the common amalgamation, which is in the nature of purchase. So if there is amalgamation which is in the nature of purchase, if there is amalgamation which is, let us say, in the nature of purchase, assets and liabilities will be taken over at fair value. Difference between PC and net assets will be in goodwill or capital reserve, as a case may be, and reserves will not be taken over. So there are 3 things. If it is amalgamation in the nature of purchase, which is the genuine amalgamations, the actual purchases like Sun Pharma acquiring Ranbaxy or a Walmart acquiring Flipkart, these are actually actual acquisitions, or Tata acquiring JLR, Jaguar Land Rover. They are to be accounted using the acquisition method where the assets and liabilities taken over at fair value. Reserves are not taken over, they are not transferable items. And lastly, the difference between the purchase consideration and the net assets will be either in the goodwill, that is the reputation of the selling company that you are acquiring, or the capital reserve, that is a profit on purchase. However, in certain rare cases, what does happen is there is actually a restructuring. 2 companies are coming together or merging, but it's not really an acquisition. For example, there is Geo Platforms, which is a company, and Geo Platforms has 4 companies. There is Geo North, Geo South, Geo East, and Geo West. Now, all of these companies are 100% owned by Geo Platforms. Now, I'm fed up having 4 separate companies. I want to merge them. Now, if I want to merge Geo North, South, East, West into a single company, or let's say Geo North acquires Geo South, Geo North acquires Geo East, Geo North acquires Geo West, for example. In which case, it might be an actual acquisition. North is acquiring West. However, at the end of the day, North was 100% owned by Geo Platforms, West was also 100% owned by Geo Platforms, and hence what is really happening is just a pooling of interest. Pooling means joining of interest. It's not really a third-party acquisition, it is just joining of interest. Loosely speaking, it is like saying that you were staying in a house which is a 2 BHK house. You also owned another house which was a 2 BHK house. Now, for whatever reasons, there was a wall in the middle, you decide to break the wall and make it a big 4 BHK house. Does it mean you have acquired another 2 BHK house? No, it was already there with you. You have just pooled the interest together, which was in 2 different houses. Now it becomes a single big house. In a similar way, it legally, Geo North, which is a separate legal entity, is acquiring Geo West. However, the shareholders of Geo North and West are the same, and hence it's more of a restructuring. And such restructurings are called as mergers, and the accounting for the same is done using what you call as the pooling of interest method. Under the pooling of interest method, the institute kind of says that, well, these are your assets only, which you are just joining. So rather than taking over the assets at fair value, which you would if you are purchasing it from someone else, you will take over the assets and liabilities at book values. A very important point over here is reserves and surplus are also taken over. This is a super exception which is done to the law. Typically, reserves are non-transferable. However, if you do not allow the transfer of reserves, people would be reluctant to join and restructure. This will kind of stifle restructuring. For example, Geo West has a P&L balance of 900. If it merges with Geo North, and Geo North cannot take over the P&L balance, in which case I've lost distributable profits. Lost meaning शायद वो capital reserve बन जाएगा या जो भी है, but I don't have distributable profits. उससे अच्छा मैं restructuring करूँ ही नहीं. And hence the standard over here as an exception says that okay, you can take over the reserves and surplus as well. Special case. Now, when you acquire someone else, yes, their reputation you are acquiring, which is measurable and which can be recognized as goodwill. However, self-generated goodwill cannot be recognized, and at the end of the day, North and West are all ultimately belonging to Geo only. And as a result, over here, the difference, if any, between the PC and the net assets, including the reserves taken over, will not be going to goodwill or capital reserve. Instead, it will be adjusted in the general reserve only. We will just adjust the reserve balance. It is just a restructuring and not an actual acquisition. ठीक है सर, ये सब तो ठीक है, but how will we know in the exam whether it is amalgamation in the nature of purchase or merger? Well, the institute has defined the 4 conditions, and if these conditions are fulfilled, it is amalgamation in nature of merger. If one of them is not, it is in the nature of purchase. Sometimes adequate data is not given in the question, so as a thumb rule, if nothing is given in the question, you can use amalgamation in the nature of purchase. What are these 4 conditions? Well, in case of a pure merger, that is a restructuring, all assets, all liabilities will be taken over, that too at book values. So the first condition is all assets and liabilities taken over at book values. Second is an important thing. Well, at least 90% of the shareholders of the selling company continue to be shareholders of the purchasing company. So like Geo North and Geo West, shareholders were common. 90% of the shareholders are common. So that is when it is a restructuring. So over here, this is sometimes not as clearly given in the question, and hence we might need to assume. So it is 90% of the shareholders of the selling company continue to be shareholders of the purchasing company. So it's like a restructuring. And the PC is to be discharged by shares only. You are not really paying any cash or anything. You are just kind of pooling the interest. So you are giving shares to these shareholders. So PC is to be discharged in the form of shares only. And lastly, the same business as it is intended to be carried out. Now 1, 3 and 4 or 1 and 3 can be inferred from questions, but data about 2 and 4 sometimes is not as clearly given, in which case you might need to assume. Institute solutions over here are sometimes being inconsistent, though a large majority of the times Institute has always solved using the purchase or acquisition method, unless they have specifically used the words like merger, like pooling of interest, etc., in which case they have solved using amalgamation in the nature of merger. So if all the above conditions are fulfilled, then the amalgamation should be accounted as a merger. If any of them are not satisfied, it would be accounted in the nature of purchase. In the exam, if nothing is given, you might check the conditions if data is available, but if data is not available, then you can show this as amalgamation in the nature of purchase, though the solutions have sometimes been a little inconsistent at this particular point. Aja, next is the books of the selling company. Now this is not covered by AS 14. However, your regular liquidation accounting or dissolution accounting will apply over here. This is the books of the selling company, which is kind of you are closing. So what are the things that you have to remember? Well, first of all, there might be a balance sheet of the selling company. Your idea is first to remove all assets and all liabilities from the balance sheet. There might be land and building, plant and machinery, inventories, trade receivables, everything, equity share capital, reserves and surplus, debentures, etc. You have to transfer all assets and all liabilities into a single account. Typically, you are interested in finding the gain or loss per asset. Now, the entire business is closing, so you don't really need to find the gain or loss per asset. In fact, you are more interested in finding the gain or loss overall on this closure process. And hence, all of these assets, all of these liabilities are transferred to a special account which is called as a realization account. And in the realization account, you will transfer all assets. So this is to land and building, to plant and machinery, to inventory. Acha, the question arises at what value? You will be tempted to transfer it at fair value because till now everything, all assets and all liabilities are transferred at fair value. You have to resist the temptation. Why? For example, the book value of land is 100. The fair value of the land is 1000. Now, if you transfer this at 1000, your land's ledger has a debit balance of 100. You have credited it by 1000. So what will you do with the negative 900 balance? The idea over here is to close each and every ledger. and then ultimately find a single gain or loss, and hence you will transfer all the assets and liabilities, remember, at book values and not fair values. All assets, all liabilities will be transferred. There is an exception. Sometimes if you still have to make a cash payment, then for cash you will not transfer, you will put it into a separate account, but other than that, all assets, all liabilities are transferred. So this is by debentures. Acha, which means these ledgers are closed. Remember, equity share capital is not a liability, reserve is not a liability, preference share capital is not a liability, they are owners' funds, and hence we prepare a separate account called as equity shareholders account or a preference shareholders account for preference shares. So in the equity shareholders account, obviously the equity share capital will go. In the preference shareholders account, preference share capital will go. The question arises that the reserves belong to whom? Remember, the reserves belong to the equity shareholders. Preference shareholders, beyond their amount that is payable to them, reserves don't go to them. Reserves belong to the equity shareholders. So all reserves, whether it is debit or it is credit, will be closed against the equity shareholders account, and hence with that the entire balance sheet is closed. Now against this entire closure, are we getting something? Well, yes, we are getting the PC. From whom are we getting? Well, from the purchasing company. So we will pass an entry, purchasing company account debit to realization. So all assets and liabilities are in realization. So by P Limited, purchasing company, we will say that against all of these assets and all of these liabilities, we are getting PC. You will create a separate P Limited ledger, and in P Limited, well, to realization, you will recognize the PC. So the purchasing company now becomes your debtor. For the liquidator, he has to collect money from the purchasing company. Purchasing company will discharge the PC in the form of shares or in the form of cash as agreed. So this is by equity shares in the purchasing company, by preference shares in the purchasing company, by bank as the case may be. So this account will close. Similarly, you might have to prepare a separate account called as equity shares in purchasing company if the PC is discharged in the form of equity shares. Now what will you do? Well, you will see, so step number 1, you have closed all assets, all liabilities, share capital as well as reserves. Step number 2, you have transferred share capital, reserves, everything to the shareholders' funds. The balance sheet becomes a nullity. Then you recognize the PC, record the PC, and then you collect the PC. After that, you see if there are any assets or liabilities which are not taken over by the purchasing company and which you have to pay. If yes, you will pass the entry, realization account debit to bank for liabilities that you have to pay, or bank account debit to realization for assets that you will collect. Or if there are certain realization expenses which you have to pay, the purchasing company is not, typically the entry is P&L account debit to bank, but abhi to sabhi accounts close ho gaye. So your entry will be realization account debit to bank. After that, everything is considered. Now we will start the closure process where we will say, ठीक है, now let us hand over what we have received. So preference shareholders ko jo, let's say we have received preference shares in the new company, we will hand it over to the preference shareholders. So let's say preference shareholders were 100, we have received shares worth 110, then 10 rupees is the balancing figure in the preference shareholders account. It will go to the realization account because that reduces the gains for equity shareholders or increases the cost for equity shareholders. So preference shareholders account is also closed, and now you will balance the realization account to find one single gain or one single loss on the entire closure process rather than an asset by asset gain or asset by asset loss. This gain or loss is to be borne by the equity shareholders, and hence the balance in the realization account will be transferred to the equity shareholders account. Whatever is the PC which is attributable to the equity shareholders will be given to the equity shareholders, and with that the equity shareholders account will also close. ये पूरा explanation है. If you go take it through steps. In the first step, you will transfer all assets, all liabilities to the realization account. Add book values. Add book values. Exception is for cash. If certain expenses are to be paid, you will prepare a separate cash account. Second, you will transfer the balance in the equity share capital and the reserves, or the expenses not written off in the equity shareholders account, and the balance in the preference share capital to the preference shareholders account. After the first 2 steps, your balance sheet is kind of redundant. Everything is in these 2 or 3 accounts only. Third, you will record the purchase consideration. You will make the purchasing company a debtor, and you will say that in lieu of this, you have to kind of give me money. And then you will receive the purchase consideration, you will receive the money or receive the shares. So the purchasing company account closes. Then you will have to see if there are certain items which the purchasing company is not taken over. Then sell the assets which are not taken over, pay off the liabilities which are not taken over, and the corresponding adjustment will be done in the realization. If there are any realization expenses, pay them off. The entry is realization account debit to bank. And then you distribute the preference shares to the preference shareholders, distribute the consideration to the preference shareholders, and transfer the balance, if any, to the realization if there's any gain or loss. Balance the realization account and transfer the balancing figure, that is the overall gain or loss on realization, to the equity shareholders. Give the PC to the equity shareholders, and after all of these adjustments, the equity shareholders should tally. All accounts are closed. The selling company is also closed. The accounting over here is not as per AS 14, it is as per standard liquidation or dissolution principles. There have been questions which have come anywhere between 15 all the way up to 20 marks. Schedule 3 understanding is important over here. Your ability to even use certain shortcuts is also important. For example, if journal entries are passed, you may not necessarily, in journal entries, all assets and all liabilities will be taken over. The balancing figure will automatically be recorded as goodwill. So you might skip step number 2 or step number 3. If a journal entry is asked, you might say, ठीक है यार, वो journal में हमको balancing figure दिख जाएगा. If you prepare step 2 and 3, no problem. But you can reduce your time that way. If journal entries are not asked and directly balance sheet is asked, then you don't need to pass these journal entries. You can do this working, and on the base of the working, you can prepare the balance sheet. Acquisition entries आप ना pass करो चलेगा, but in the working, for the entries which have certain adjustments, you will have to show the working notes for them. You need to practice this chapter on pen and paper, undoubtedly. If there are 20 sums in your book, you have to at least practice 10 of them on pen and paper, and other in fair and other on rough, because this is one chapter which is coming for 15 to 20 marks. That's close to 20% of your overall marks weightage, or 15%, and it's largely practice based. When you hear this, it is quite big, appears intimidating, but it's a general process flow. The questions have not been particularly difficult or challenging. They're quite manageable as long as you've practiced it well. I hope this video was helpful for you. Thank you very much for your time, and see you soon. Bye-bye.